Good afternoon. How are we all doing today? What's up, Dave? What's up, Joanna? Mike Reed in the house. What's up, Bill? TJ, Dimitri, Tom, Michael. What's going on, everybody? Alec here, Ryan. Good to see you all. What's up, John? Good to see you too. All right, let's jump in. Today is, what day of the week is it? Wednesday? I always get confused on these short days. Yeah, Wednesday. Wednesday, January 17th, 10 after 4 Eastern. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure is the same as yesterday, except I added on a pretty small Apple position. Sold some of it into the up move this afternoon, but kept a very little bit. Let's talk about the market. So today was, I don't know, kind of a choppy trading session, but it really felt like a do or die trading session to me, with the market testing some really key levels on the downside for the SPYs and Qs, testing some really important momentum support levels, and then the IWM in its own universe testing like a more major support level after what has turned into a pretty healthy sell-off today. So I generally liked the idea of looking for longs this morning, really especially in the IWM. I think it was one of the things I mentioned in the morning meeting today was to potentially look to buy the IWM off the open versus opening lows. We talked about a couple different ways that you could do it, but that was one of them. And the IWM worked out pretty good. For the most part, you know, SPY chart is up here. You can see the large gap down. Whenever you have these large gaps in the beginning of the day, you need to see how the market handles that gap. I want to see what the market looks like after the ADMA catches up to price action. Technically, this was actually a bear flag here in the beginning of the day, with the flag pole representative as the gap. And this consolidation is typically bearish here, but we were able to break up into this ADMA, break into new highs, and then we kind of went into this upside grind. The big level I've been talking about all day for the SPYs is 472 quarter. Let's pop over to the daily charts. 472.26 to be specific is the low of January 11th. What I've been saying for the SPYs and the Qs is that's an important momentum support level. So what do I mean by that? Like, it's not a major support level where if you lose it, you're in a downtrend, right? It's not like a reversal level if you lose that. If you lose the January 5th low, that signifies a real character change for the market, and that would be a real big problem for bulls. But this more recent low here from Thursday of last week, where we had that continuation hammer, that's what I'm calling the momentum support level. So if you're looking for just continued upside momentum in this market, for the most part, you really want to see that level hold. And when I talk about holding a level, I usually mean on a closing basis. Where do we close today? The closing print is 472.26. We closed at that level to the penny. Technically, that means we still held it, but it's to the penny. So if we really start losing that 472.26, the market doesn't necessarily need to break down. It just means that the pure momentum continuation that a lot of people might be looking for might be off the table in the short run. And then we have to see, well, does this market just need still broader correction of the November-December move, building out an even further bull flag, maybe letting some weekly chart or even monthly chart moving averages catch up a little bit further. You can see the ADMA on the weekly is just about caught up to this base from the last 4 weeks or so. Do we need that for continuation? Do we go into a more of a range-bound style market? That's what I would kind of think if we really lose that level. But yet we're still more or less holding the lows of the year. Is maybe just a broader consolidation is needed, more range-bound price action is needed. But again, we held it to the literal penny today. So momentum bulls, you're hanging on by a thread, but you do still have the market on your side for your long positions. The Qs, the exact same spot that we were looking at is 404.24. And we did trade below that at one point today. We traded a good bit below it. I think we even gapped below it. No, we didn't gap below it, but we were within, within 15 minutes, we were trading below that 404 quarter area, which is the important momentum support for the Qs. But the Qs closed on highs. They didn't fully fill their intraday gap, but they closed on highs. And honestly, this is another healthy looking daily candle here for the Qs. Downside tail into the 21 EMA. This could be the beginnings of another pivot. And again, on a closing basis, we still managed to hold that 404.24. So SPYs are intact, barely. Qs are solidly intact. Actually gave a great looking candle today. What about our canary in the coal mine? What about our problem that we've been talking about here the last couple trading days with this IWM relative weakness? Well, the IWM is giving us a completely different story here than the SPYs and the Qs have. That's been the theme that we've been discussing. It also makes logical sense. The IWM is very interest rate sensitive. I think in some ways it's a lot more interest rate sensitive, and we spent a lot of time talking about this in 2023, so I won't go too deep into details. But we know that a lot of those Magnificent Seven stocks, like Apple and Microsoft as an example, they've got 30, 40-year debt locked in at next to nothing, whereas the IWM names, they don't have debt that is extended for that long. So at a certain point, they run into, and it really probably begins in 2024 and becomes more earnest in 2025, kind of a debt cliff where they need to renew their debt at significantly higher interest rates, which is the reason why the IWM has been trading so much, I'm doing air quotes right now if anybody could see me, cheaper than, like the NASDAQ has. It's been cheap for a reason. That's because interest rates have been higher, and that can negatively impact this IWM. So the theme that we've been talking about here in January, and it's interesting because Goldman, I think, had a note out this morning that was similar to what I've kind of been saying, is that the market seems to be overpricing in these interest rate cuts, in which case you'll see the TLT move lower. Guess what? The TLT has been grinding down all of January, and you'll see these IWM names be most negatively impacted by it. It doesn't necessarily have to hurt the market too badly as we reprice the Fed funds futures to normalize what the Fed has been telling us for interest rate cuts. But it's not surprising that has led to the most amount of weakness coming into the IWM. With that said, we talked about in the morning meeting, down at 188 where the IWM was trading when I was doing the morning meeting, I think I calculated roughly that the IWM from its closing high at the end of December is now down like 8.25%. That's like borderline correction territory, right? Market correction is 10%. So at this point, that's like a pretty healthy correction that's come into the IWM as we've seen the TLT move lower. And as of this morning, we're seeing a pretty large gap down in the IWM into major support. This 188 area, 187.75 to 188, I think is specifically what I wrote in my little morning note, is just a major support area that the market needs to hold. It's the beginning of it. I think that actually extends down to this positive Maribozu low, which is 185.67. So at this point, 8% plus down in the IWM into a major support level with healthy downside extension. Not extreme downside extension on the daily chart, but healthy downside extension. For me, that is exactly when I want to be looking the other way for the most part in the IWM. If I could have gotten, like I said in the morning meeting, if we could have traded down to 186 in the IWM this morning, that's when I probably would have looked to be super aggressive actually to the long side in the Russell and some of those names. But there's a trade here, even on the first test of this support zone, 187.75 to 188 that we communicated in the morning meeting, and that worked out really well. You could see at the beginning of the day the relative strength in the IWM compared to the Qs or the SPYs really solid. Quick downtick for like 2 minutes into that support zone. Long off the opening low, worked out really well for a bounce back all the way to 190. And then, as sometimes happens, the market just kind of, I don't know, didn't really do anything for the entire rest of the day. I wanted to see if we could get above 190, which was yesterday's low area. We could never really recapture 190. But at the end of the day, the IWM held major support and was able to bounce off of it. The SPYs held on literally to the penny to its momentum support, and the Qs held on to its momentum support and actually gave a decent candle. So the market bulls still are intact. It does feel precarious. But the market bulls are still intact, and we want to see if this can actually create more of a real pivot low for this market, and technically if we can work our way higher from here. We technically should, but if these indices were to lose today's low at any point in the near future, then I think we have a little bit of bigger problems, and we'll have to kind of reassess the market. But today felt like a battle. That's what I was kind of saying in the very beginning of the meeting today. I think I was saying it in the VTF earlier. Today really felt like a battle because we were back and forth, barely trying to hold on to that 472 quarter that he was talking about all day for the SPYs. The Qs needed to get back up. The IWM needed to get back above that 188, and the Qs needed to get back above 404 quarter. All three indices were able to hold their important levels today. So it made an important day. Technically, it is still a victory for the bulls, but the bulls actually need to give follow-through off of this. And that's kind of been the thing, is I feel like we haven't really been able to get major follow-through. Obviously, we had that pivot low on January 5th, and the SPYs were able to make new highs off of it, and the Qs gave a great bounce. but this hasn't been like real bull trend resumption. I don't think you could argue that. It's been real bull trend resumption, like off, continuation from the November-December move. At least not yet. But like we've also stated a whole ton of times here, the November-December move was massive. Markets work in periods of expansion and consolidation over time. November and December was an expansionary period. To have kind of the second half of December and first half of January be a consolidation period, it's not surprising. It's not a bad thing. It's not bearish. If anything, it's actually bullish. So we're hitting the point now, though, where we just looked at the weekly. The weekly ADMA is caught up. I think that the bulls need to give some follow-through off this pivot here and not just have it be an area to hold. But if anybody was able to capture some good longs this morning and still had some into the close, it's probably not a bad idea to swing them. We had some incredible intraday call-outs today, particularly the call-out at the low of the day in the Qs. It was just a fantastic call-out. We took kind of a couple stabs at it. I think on the 955 bar at one point, it started to create a doji, but hadn't closed yet. And I said, hey, you could go long versus the low that had already created in this bar. If you took that and kept it tight like that, you probably got stopped out. But then immediately after that, at the 10 a.m. bar, when the pivot came in, and we saw a lot of the big cap tech stocks also giving good-looking pivots. Meta almost seemed like it gave like a mini capitulation hammer at that point. That try it again. Let's go for these longs, and then that trade was a really good call out. And I'll kind of repeat a little bit what I said earlier in January, that if you can nail those pivot lows on the daily chart at the right spot and then swing some of that stock, that's how you really get follow through for a risk reward perspective to the upside for continuation on your actual trading. So again, the call out here I think at lows was honestly pretty phenomenal. It's a counter trend trade in a market that's trading weak. The game plan stays the same. We don't know that the market's going to close on highs when we're buying 403.15 or whatever in the Qs versus lows at this point. Get the risk covered. Target number 1, it's a counter trend trade, becomes the 80 EMA. Target number 2 becomes the 21 EMA. And then like I was saying at a certain point before I got off the radio at 10:45, 11 o'clock, at this point, any of those longs that you put on down here versus the 10 a.m. low, you should probably still have 25 to 50% of the position depending on how greedy you're being based on the daily chart. And that 25 to 50% of your position, you want to look to be really greedy with. Because then when you get a close like this, next thing you know, you've got some cues from, again, let's just call it 403.15 with a close at, 407 quarter. You close in $4 in the money and you're getting a good looking daily candle. It's not inconceivable that this daily candle here becomes a pivot that leads to a break of December highs, that leads to a break of all-time highs, that leads to a move to 425 in the Qs. That's not inconceivable, and that's where I find that a lot of my best trades come from a reward perspective, from a risk-reward perspective. That's exactly the type of stuff that we're looking for. And again, it didn't just have to be the Qs. We called out Meta. Meta on the way down when it was trading through 360. Pat said, hey, I think that there's something going on with this Meta. It feels like it's getting really extended here, potentially about to capitulate. And then a couple minutes later, I found myself calling out the long off the tail low here with the extension, with the volume confirmation. If anybody has ever seen my candlestick class in my training program, which is the second class I think that's in there, where I talk about that hammer capitulation kind of counter trend setup, this is textbook. This is textbook. Volume maximizing on that candle, large tail here, buyers taking control from sellers, a ton of extension, get the risk covered, sell more at the 80 EMA, sell more at the 21 EMA, keep a percentage to see if that retracement can become a reversal. You could easily have stock, I think we called it out actually below 360 for the buy. You could easily have stock from 359.50, same deal as what I was just saying with the Qs, closing $10 in the money here. Look at this daily chart in Meta. It looks beautiful. It's still super strong. Continuation doji into equilibrium area. It's not inconceivable for Meta off of this low to work its way up to $400. And then the question is, did your game plan allow you to be greedy enough to still have stock at $400? I want the answer to be yes. So Meta also just a really good call out there. Amazon, same deal, same time, really good call out. Google, same deal, same time. Another one, high volume, hammer, downside extension. You get a really good looking daily chart as well. I mean, it was just kind of one after the next. It was just a matter of, did you take the trade? Did you put the stop in? Did you manage the upside properly? In my opinion, looking at any of these charts on an intraday basis, looking at this Google here, there's no reason why traders shouldn't have some stock in some of these names into the close, and then swing them because your profit cushion is good enough to see what sort of upside follow through you can still get from these names. So those trades were great, and that was in what was the relatively weak sector pretty much all day, which was the Qs. The IWM is very similar but different. Big support level there at 188. You could have stock from the beginning of the day. I would have liked a little bit of a better close. I would have liked to close above 160, but not terrible if you're $1.40 in the money or whatever at the end of the day in the IWM to see if, hey, maybe this can actually become a real pivot low now that the low here was 8.5% down or whatever from highs into major support. I'm not... Forget about, like I was saying with the SPYs and Qs breaking, new recent highs, but you could easily just get a snapback to, I don't know, $192, maybe even $196, $197, retest this previous resistance level, and then you still have stock from 188 with, very small risk. It also goes back to what I like to talk about all the time, which is looking for intraday risk for daily chart reward. That's what you're doing. If you have the IWM intraday off the opening low, if you've got, Google, Amazon, Meta, any of those ones we just talked about, or the Qs, you executed with intraday risk. At the end of the day here, you're swinging a percent of your position because it looks great, and you want to see, hey, what kind of daily chart reward can I get? And people love to talk about their risk-reward ratios. I want to risk 1 to make 3, or risk 1 to make 5 or 10 or whatever. I actually don't do that at all with my trading. I don't do that at all with my trading. Because I know that if I can find spots for intraday risk and I can get daily chart reward, that the risk reward ratios, they just naturally come together. And then if anything, I think that a trader overly focusing on risk reward ratios can actually be reward limiting. Oh my God, I'm 5x in the money. Let me liquidate my position. Well, what if that trade became a trade that could be 100xer? Those are the trades. They're not going to happen all the time. They're going to be relatively low probability. But if a trade has the potential to be 100xer, be there for it. Be there for the reward. So I think that it was a pretty good day today. I think as a team we were really on point with call-outs in the beginning of the day. Not everything worked perfect, but enough stuff worked really, really well that if you executed well and traded well, it should be a decent day for you. So that's all that I've got, I think, for my thought process for today. I am happy to answer any questions that you guys have. All right, so scrolling up in the VTF, first thing I'm seeing here is a question from Christian at 4:13 p.m. Great call on the long at 1:45 p.m. I almost forgot about that one. We also called out this long here at 1:45. There's another one where I was actually like a couple minutes too early. I called it off the 1:40 low. I said we could look for the long. It happened 5 minutes later, but good enough. It seemed like a few of you guys were able to capture it. So the question is, I'm still having a hard time with my conviction in this setup. Could you talk more about what your thought process was the time that you called it? Sure. So when looking at anything that's going to be counter to the direction that the market's currently moving, first thing I would say that's always a difficult trade, but you want to pay attention to, right, maybe it's counter to how the 5-minute chart is moving, right? The 5-minute chart's moving down and you're looking to go long. But is it counter to how the daily chart is moving? Because if you have a mixed message, meaning you have a 5-minute chart that's trending down and a daily chart that's trending up, one of those things will eventually have to reverse. Either the 5-minute chart just stays so weak for so long, days go by, the daily chart rolls over, or the 5-minute chart, and this is what tends to happen, this is much higher probability, the 5-minute chart finds some support, reverses off that 5-minute downtrend that you're looking at and moves back in the direction of the daily chart. So the first thing, even if you're just looking at a small time frame chart, like when everything I was just going over, a similar question, Christian, could be about going long with the Qs or Meta or Amazon or Google. It's a similar trade as to this one. Is like, okay, what is the large time frame still telling me? Is a large time frame going to be on the side of this trade? If so, that inherently creates a higher probability of me having a good trade going counter to the small time frame direction, right? I wouldn't like this trade if the big picture daily chart was in a downtrend right now, at least not in the same way. So I know that the big picture is on my side. Now when it comes to the small picture, again, I just want to be kind of measuring extension, and I also want to know my levels, right? So what you have to remember about this time of the day here at 1:45 p.m. is that, I'm trying to figure out the right way to describe this, extension tends to be much less extreme at this time of the day than in the beginning time of the day, right? The beginning of the day is your price discovery period. Markets move much faster. There tends to be more of the momentum period of time in the market. So you can see here the Qs, heavy momentum selling for the first 30 minutes of the day, leading to very large downside extension on a 5-minute chart by 10 a.m. At 10 a.m., the low in the Qs is 402.92. The ADMA is 404.72. You have $1.80 of downside extension in the Qs on a 5-minute chart at 10 a.m. That's a lot. How do I know that it's a lot? I really don't have like a chart or a spreadsheet that I can show you about, this time of the day, this is extreme versus this time of the day. Honestly, it's more just, I think, trading experience. I wish I had a better answer for you on that. You just know, I know from trading that, especially on a day when there's no real new news. I know we had retail sales number this morning, which was market moving a little bit, but for the most part, it's not a Fed day or a CPI day necessarily. $1.80 extension at 10 a.m. is a lot. it's pretty rare that the, you know, lower band of equilibrium, in this case, which is the ADMA, doesn't touch the market by 10 a.m. It doesn't happen that often. So you're looking at that extension, you look at the volume pickup, you don't just buy on the way down, buy on the way up. That's the other thing we always talk about, right? So whenever I'm calling out the longs, I'm calling them out after I'm seeing this pivot potentially coming in. I'm trying to call them out early enough that you can still get involved for good risk, right? Good risk reward. But at the same time, I'm still trying to wait for some signal. And that's why I also said, to be fair, I called it up twice. The first call out, I was wrong. And it's because when you're trying to be early so that you can get better pricing, that inherently also means that there's a higher probability that you could still get pushed out. And that's what happened if you tried it at 9:55 before this candle closed. As at the close of this candle, it just looks like a garbage downside continuation. But I can tell you, because I traded at that time of the day, at one point, this was trying to create a downside tail, but hadn't closed yet, and I was already calling out the long because of the same thing. It's extended. It's almost 10 a.m. Now it's moving up, so you'd be buying on the way up versus that low. And if you tried that and you kept it tight, you got stopped out the first time. So the counter trend stuff is definitely not perfect. And then the second one actually worked. Now, at 145, the trade is similar but different. Daily chart's still on the side of the market for the most part, though it's a little bit concerning that we're below 472 quarter. This is a pretty big downside move intraday when there was no real news that came out. I think we might have had some Fed speak at 1 o'clock. I honestly don't exactly remember which could have added to this a little bit, but from what I saw, the Fed speak that came out midday was nothing new. But this is a pretty big down move for the 1 to 2 p.m. period of time. You're going to tend, unless there's a news event, to not be able to get the same extension in the middle of the day as you can off the open. So you have this buy, it's just selling, it's selling. We have basically a straight down move from 472 to 470, $2. And again, you got to be careful on the way down, but then you're also approaching 470, which isn't necessarily a level, but it's kind of a round number, which I'm going to say matters maybe a little bit, but not a lot. I wouldn't put a whole lot on round numbers as just being something that holds because they're round numbers. But it was kind of the same deal here. It was looking for the extension buy on the way up, and I did the same thing. I know Rich and a few people were still able to capture it. I actually initially called the long off the 140 candle because it's kind of what I was describing. Here's a little bit of a downside tail. The market's extended for this time of the day. It's been a pretty big move to the downside over the course of the 45 minutes of basically straight selling. This candle means that buyers are starting to come in. Okay, fine, let's try it. And again, if you tried it there and kept it super tight, you probably got stopped out, which is fine. It's fine to wait for a signal, take a buy, and then get stopped out. That's totally fine. That's what risk management is for. And it's also, again, what makes counter trend trading sometimes so difficult. Sometimes it takes either you need to build in and be looser with the stop and smaller with your size, or you need to sometimes try it a couple times. I know Pat does that a lot. Pat is always the one who is sometimes, Pat's the master, we know, at like kind of these counter trend trades. He's super patient, but I'm sure if he was doing the afternoon meeting, he would tell you that sometimes he has to try it multiple times. So it's the same thing. You buy it on the way up, and the signal here was a little bit difficult because it's over 2 candles, but it really kind of became like a king-queen reversal where you get the low that comes in, and then you can be buying it on the way up, versus that low. But I don't like the trade here so much, as an example. I like it here because of the other factors, just the amount of selling by that point, the degree of extension that's coming in. And I also tend to not like midday trading as much. I'll call stuff out if I see it, but I prefer and find that there's much better reward in these 10 a.m. low trades with their extreme extension, like we got, than with the SPYs at 145. Even though I did call that out as well. Thanks for the question, Christian. I hope that helps. From Chris C. Pretty basic question, but I hear the team mention 15-minute corrections a lot on stocks after moves in the morning. I don't exactly understand what to look for, how to spot a 15-minute overextension correction. Do you have any guidelines of what you look at when you spot those? Sure. So, when you look at when you're involved in technical analysis and with charting, for the most part, this is not necessarily 100% truth. The same rules apply for every time frame that you're looking at. So, how do I define market extension would probably be the first thing to answer or to review. For me, I consider what I call technical equilibrium for any stock or any market to be the space between the 8 and 21 EMA. So in a market that is trending down or moving lower, that 8 EMA is going to be what I call the lower band of equilibrium. The 21 EMA will be the upper band of equilibrium, and the space between is technical equilibrium. So if you're trading in between the 8 and 21 EMA on any time frame that you're looking at, you are basically trading at equilibrium. If a stock is trading below those moving averages or above those moving averages, those stocks are extended. And then there are degrees of extension. Technically, if a stock is trading even 1 penny below or above the moving averages, below the 80 EMA in a declining move, or above the 80 EMA in a declining move, even by 1 penny, you could say that the stock is extended by 1 penny. But that doesn't matter, right? Extension is it's a relative term. You have to be extended compared to something. And the thing about markets is that they can always become more extended, especially when there's volume or news or momentum. So, the beginning of the day here, we spent a lot of time talking about downside extension on these small time frames, on 5-minute charts, on 15-minute charts. But at the same time, there are times when we could be talking about upside extension on the daily chart, right? We've been dealing with more upside extension on the daily chart of the SPYs and the Qs than downside extension, obviously, over the course of these last couple months, because we've been trading up. So you could in theory have a market that's extended the upside on the daily chart and extended the downside on the 5-minute chart. Now, the next thing that you need to know, now that we've kind of defined how I look at extension, is we need to understand it on multiple time frames, because there are degrees of extension. Again, on the daily chart for the SPYs and the Qs, we have been broadly defining the SPYs or Qs being more than $10 away from the 80 EMA, either the upside or the downside, as extreme extension for the market. Which doesn't mean that it has to go the other way. $10 of extension can become 11, 11 can become 14. But it's a mathematical law, basically, that eventually that degree of extension can't last. Eventually, extended markets will have to correct through time or through price, which is when those moving averages catch up. So when we're dealing with a gap down, to go back to the small time frames, when you're dealing with a large gap, down or up, today we had down, when the second the market opens, it will inherently be extended on the small time frames, 5-minute charts, 15-minute charts, okay? You can see, and it corrects very quickly. You can see, this 80 EMA is almost vertical to the downside. It's approaching so fast. But you can see here by the second bar of the day, the 935 bar, the market is trading at 271.70, and the 80 EMA is at 273.25. So on the 5-minute chart, we could say that we were extended at that point by $1.50, and that is pretty much entirely from the gap. So in the beginning of the day, when we have these large gaps, the first thing I'm looking for from a trading perspective is how does the market handle that? And I'm first looking at a 5-minute chart. Okay, this is when knowing the importance of time frames is, well, that's when it's important. 5-minute charts are very, very relevant in the first 30 minutes of the day, first 45 minutes of the day, even first hour. But it's somewhere at about 10:15 a.m.-ish that the 15-minute chart takes on more significant importance. I would say that, starting at 10 a.m. is when the 5-minute chart begins to have less importance. The 15-minute chart begins to have more importance. And then by 10:15 to 10:30, I would say that the 15-minute chart actually has even more importance than the 5-minute chart. Because what tends to happen, this is just the way kind of these momentum rules work, is, and I keep using the word tends on purpose, what tends to happen, because in the market, anything can happen. If you trade long enough, anything will happen. There'll be periods of time. I mean, we were trading AMD yesterday, right? And it didn't touch the 80 EMA on the 5-minute until after 11 o'clock. That's extremely rare. Most of the time, by 10 a.m., the market needs to have corrected to the 5-minute chart equilibrium area. Most of the time. Again, there can be exceptions. AMD yesterday is a perfect exception where it didn't happen. Most of the time, if you're still looking at extension, let's go back to the Qs, at 9:55 a.m. and 10 a.m., it's hitting the time of the day where that really can't last. It really can't last. So that also helped me with my conviction in the market at 10 a.m. to say, all right, we can really be looking for the other direction here for at least just a snap back to equilibrium. And then let's take it from there. In a really weak market, let's say we're in 2022, it's a bear market again. In a really, really weak market, this still has to happen. The difference is, in a bear market in 2022, in a downtrending market, this is all that's going to happen. You still will need this price time correction to the 80 EMA on the 5-minute. It usually needs to satisfy itself by 10 a.m. And it starts just becoming a more and more rare occurrence later in the day that you go that you haven't seen a touch of the 80 EMA on your 5-minute time frame. But in a bear market, that'll be it. You get the snapback here, this 15-minute snapback. You create this pivot high at 10:15. That's a pivot high that you could short versus, and the next thing you know, the market's making new lows and it's having downtrend continuation. In this market environment, and this is why I said earlier when I was asking Christian's question, what's the daily chart doing? The daily chart is still intact. So that means that there's a higher probability that this pivot doesn't actually lead to new lows. It will give a little pullback that leads to a higher low that actually leads to a reversal on the small time frame. But again, okay, we got the correction here, 10:10, 10:15. We touched the 80 EMA on the 5-minute chart. Well, what did I just say? It's usually at this time of the day that the 15-minute has increasing importance. The same rules I just described on 5-minute charts or even daily charts also apply to 15-minute charts. And it just so happens that once you get to that, 10:15 to 10:30 area, that's when I'm saying the 15-minute chart becomes more important. But the same rule that I was just kind of saying for 10 a.m. 5-minute chart extension where you need to touch the 80 EMA, that really begins to apply, I think, to the 15-minute chart by 10:30. By 10:30, if you're still really extended on the 30-minute chart, you're probably going to need more of, even if the market's going to continue to go down, you're probably going to need more of 15-minute style correction to actually enable that market to go down. So, that's what I mean, I guess, to directly answer your question about, you hear me say it all the time, and I definitely was saying it today because we're doing these counter trend trades. It's all right, we just got our 5-minute correction here, but hey, guess what? It's 10:30 now, so most likely this market's going to have to correct on the 15-minute chart. So that could mean that we just go sideways. We could just go sideways and sideways till 11 o'clock, and eventually the 80 EMA on the 15-minute chart. And by the way, the 80 EMA on the 15-minute chart usually has a very similar price to the 21 EMA on a 5-minute chart. A lot of times when I'm communicating 15-minute chart information, I don't even actually look at a 15-minute chart. I look at the 5-minute chart, but I know what the 15-minute chart looks like because I can see the 21 EMA on the 5-minute, which again tends to coincide to the 8 on the 15 for whatever reason. Did not sound exact, but they're very similar prices. And then it's like, okay, boom, now we got our 15-minute correction. Is that it? Are the bears going to take control and bring us down? That easily could have happened, but again, the daily chart is still intact. So while the daily chart's still intact, I'm going to assume that these bounces can lead to more than just a shallow bounce to the 80 EMA, and that's actually going to be the higher probability trade. And if I'm wrong, then so be it, stop me out. So thanks for the question, Chris. I hope that helped. From Dave, Hey Dio, I was watching the level you were talking about in the SPY midday today, starting at 11 a.m. ish. Does the fact that the SPY grinded against it but failed to trade above it for any period of time indicate that someone big was shorting right at that level? Doesn't necessarily have to be shorting. It probably means that someone's selling, but it could be someone who is, continuing to long sell positions that they have, maybe that are in the money from November and December, and it's a big fund, and they can't just market sell the position and be out, and they're doing it kind of methodically. Or someone who is out of the money more recently, saying, "Okay, this bounce is my opportunity to manage my risk and get out of the position." I don't know if that's necessarily short selling or long selling, but markets tend to respect levels, right? So previous support oftentimes becomes future resistance. Future resistance becomes future support. Definitely just messed up saying that correctly, but you know what I mean. So that was their question at a certain point today when I'm looking at the SPY is pushing against that 472 quarter but failing to really be able to get above. Well, is this just because the market has memory and that same spot that it was acting as support previously is acting as resistance? I don't know. So, yeah, it was important that we were able to get above it, and we really struggled today, but somehow had this miraculous rally for the last 30 minutes to get us there. We'll see if that's enough. Cool, good stuff, Chris. Cameron, the bond auction, that was that one. Thanks for the reminder on that. Blah, blah, blah with your 2-minute charts. Bunch of stuff over here on YouTube from Cyril. IWM strength at the open was remarkable. It was totally opposite to the Qs. It's actually what we were looking for kind of this morning. Chances that we see sideways or some correction, but buyers will be defending key levels aggressively. Yeah, like I was saying in the meeting here, the buyers are still intact on these levels. The bulls are, and they need to make sure that they get held because they're flirting with losing a degree of control, and we don't want that to happen. From Kevin G, what are your thoughts on trading the IWM if the banks are showing strength? Yeah, so the IWM, it moves with the banks, it moves with the energy names, it moves with the XBI. Sometimes it moves a little bit with those growthy type stocks. So I don't think that you could just entirely say, hey, the banks are strong, so I'm trading the IWM, or hey, the IWM is strong, so I'm trading the banks. It doesn't always work out that way. Sometimes it could be that the banks are weak, but energy is super strong, and other non-bank mid caps and small caps are super strong, and that creates the IWM strength. So I don't really think you want to be looking at anything in a vacuum. But I would say separately, I do like some of these banks with the right trading setup. So appreciate the question, Kevin. From Gabriel, I also tried the IWM today, covered risk, and I'm holding some. Awesome, I love it. Figured you guys are also doing it. It was on the radar. Do I think that Shop, Uber, Datadog can be a trade for tomorrow? Let's take a look. Shop, just super strong name still. Daily chart looks great. I like that tail. It's a big tail. But yeah, it's one of the strongest stocks in the market. Definitely worth keeping on the radar. Uber is also same pattern. Super strong stock. Hasn't corrected down with the market. Good looking downside tail there into equilibrium. And Datadog's phenomenal. Breaking out here on the daily chart. Yeah, they all look great. From Apex Joy. What are your views on NUE, BX, NSC downside risk before their earnings? So I don't know when any of the earnings reports dates are for these names, and it's probably something that I need to know in order to answer that question. I would also honestly let you know that I don't really trade these stocks. I don't really trade Nucor. I don't really trade Blackstone. NSC was Norfolk Southern. Southern, was that the one that was crushing the XLU? I don't remember. I think that was actually a different one when I look at the chart. But yeah, we can look at the technicals and I can try to form an opinion for you. But again, keep in mind, I don't know when the earnings reports are. I'm not going to advocate you holding stock into earnings unless you have a massive profit cushion on it, because then you're gambling. And I definitely have no idea what the stocks will do after they report. And again, I don't know when the reports are. But this new core does not look special to me at all, charting wise. Get a little consolidation here. It'll look better to the long side above 172. It'll look better to the downside below 167, just whichever way the consolidation breaks. BX here, another one I can't tell you the last time I traded this. Extended to the downside though. There was a long opportunity. It looks a little bit like the IWM in some ways. You know, gapping down really big, but still above this December 13th low. Day 3 to the downside with some extension. You could have looked at this thing, I think, today. Just don't know I don't know necessarily know that 115 was important to be long versus. It seems like the more important spot was honestly like 112.50, which was a ways away and not a good risk reward to be buying at 115. But this looks okay for if you already have some, for continuation of an oversold bounce. Again, no idea when the earnings are. And NSC is a very different company than NUE, but the pattern is very similar. Just in this consolidation. Which way will the consolidation break? I don't know. Probably higher probability that they'll break to the upside because the market's still intact and these things have been relatively bullish. But you want it above 230. I think it starts looking better, and that could be a long point. Or you don't want it to lose 224 if you're trying to be bullish. If it loses 224, it could even be a short trade there. Follow-up question from you: is there a continuation rotation going on from value small cap financials into the M5? Ooh, I haven't heard that one before. The M7 minus Apple and Tesla. Well, there definitely has been. We've constantly been rotating back and forth. It's funny that you're saying a rotation out of value small caps and financials into big cap tech, because I would argue that even though we had outperformance here in the IWM, especially in December, the IWM still never fully caught up to the SPYs and the Qs. So really, to me, rotation would probably actually still be more the opposite. Can we get rotation still out of the Mag 7 and into small caps and mid caps? It probably depends mainly on interest rates, the answer to that question. And for now, I guess as I'm just thinking about your question out loud as I answer it. If the TLT continues to move down, then yeah, you probably see money primarily coming out of these IWM type names and going into Microsoft for the same kind of interest rate reasons that I was stating earlier in the afternoon meeting. So appreciate the question there, Joy. All right, it looks like I got through all the questions in the VTF and YouTube. I hope everyone had a good day today. If you're watching on YouTube, you know what to do. Give me the thumbs up. Have a great night, everybody. I'll see you all tomorrow.